64 days. Count forward from this morning and you land on the 20th of September, and at 1 minute to midnight that night, a door closes on a decision most people in this country have not been told they are being asked to make. This winter, the government will send heating money to around 9 million pensioners across England, Wales and Northern Ireland. For most of you, it will simply appear in the bank in November or December, the way it used to before all the chopping and changing, with a letter beforehand telling you how much. But for around 2 million of those 9 million, the money will arrive with a string tied to it, and the string runs all the way back to the tax office. What the government gives with one hand in December, it has already arranged to take back with the other through your tax code later on. Whether that string has your name on it comes down to a single number, and I would put money on most people watching not knowing today which side of that number they stand on. By the end of this video, you will know. You will know what the string costs if you leave it attached, and you will know why doing nothing, which is what most people will do, has quietly become twice as expensive as it was last winter. That last part sits in a page of official guidance that almost nobody has read. Stay with me, because I am going to read it to you. Who does this touch? If you were born before the 28th of June, 1960, and you live in England, Wales or Northern Ireland, the winter fuel payment is coming to you within months, automatically, without a form. Scotland now runs its own scheme with its own name and its own dates, so if you are north of the border, the small print differs, though the big idea is much the same. And if your income sits comfortably under £35,000 a year, stay with me too, perhaps more than anyone, because the biggest mistake this autumn will be made on your side of the line, by people handing money back out of sheer worry. I will come to that, and to the neighbour of a woman called Jean, who very nearly made it. If we have not met before, a word about what this is. I am not a financial advisor, and nothing here is personal advice. What I do is read the government's paperwork slowly, line by line, so you do not have to, and then tell you what it actually says, in plain words, the way a neighbour would across a kitchen table. If that sounds useful, the subscribe button costs nothing, and it means you will hear from me the moment any of this changes. 2 promises before we start. There is one sentence in the tax office's own guidance about the winter after this one that changed my mind about what September is really for. I will show it to you near the end. And you will meet Jean, 74, who did a small favour for her nephew and got, as her reward, the trickiest money question she has faced in 50 years of paying her way. Here is the machinery, stripped of jargon. To get the payment this winter, you need to have reached the qualifying age by the end of what the rules call the qualifying week, which this year runs from the 21st to the 27th of September. In practice, that means being born before the 28th of June 1960. If that is you, and you live in England, Wales or Northern Ireland, the money comes on its own. Most people get a letter in October or November saying how much, and the payment itself lands in November or December. How much is it? For a person living alone, £200, rising to £300 if you were born before the 28th of September 1946, which in plain terms means the winter you are 80 or beyond. Share a home with someone else who qualifies and the money is split, which is why some couples see £100 each land in 2 accounts rather than one round 200. Couples claiming pension credit together are treated differently again, with one payment at the full rate for the household. There are edge cases, care homes among them, where the answer depends on which benefits you receive, and the government website spells those out. A small group does need to claim, people who have never had the payment before, or who have put off drawing their state pension, and who are not on any benefit that triggers it automatically. If that is you, claims for this winter open on the 21st of September. Everyone else does nothing, and the machine does its work. So far, so familiar. Now for the part that is new. Cast your mind back 2 winters. The government announced that the payment, which had gone to every pensioner for decades, would go only to those on pension credit. Millions lost it at a stroke. The anger did not die down, and by June of last year, the government changed course. The Chancellor, Rachel Reeves, called the original cut, and I quote, "a tough decision, but the right decision," and then unveiled the compromise we now live with. Everyone qualifies again. 9 million people, more than 3/4 of all pensioners in England and Wales, get the money paid out. And then, quietly, around 2 million of them give it back. The mechanism is the tax system. Nothing extra comes through your door and nobody knocks. The whole business happens inside your tax affairs. If your own income for the tax year is over £35,000, His Majesty's Revenue and Customs will recover every penny of your winter fuel payment, usually by adjusting your tax code or through your tax return if you already fill one in. Your income, note, and yours alone. Your husband's pension, your wife's salary, the savings in your partner's name, none of that counts against you. Each person in a household is measured on their own money. That single detail kills off half the frightening stories going round, because this is nothing like the old means tests some of you remember, where a spouse's income could sink the whole ship. And the payment itself is worth defending. Nobody is doing you a favour here. You paid for this, one payslip at a time, across half a century of work. The question this video answers is narrower. Whose payment stays put? Whose goes back? And what choosing looks like before the door shuts in September. £35,000. Where does that figure actually bite? The guidance lists what goes into your total, and the list is longer than most people assume. Your state pension counts, every week of it, and people forget that first. On top of it go any company or personal pensions, wages if you still work, interest from savings, dividends from shares, rental profits if you let out property, and most taxable benefits. Where an account or a property is held jointly, only your share goes in. Add it all up for the tax year and set it against the line. At £35,000 exactly, you keep the payment. Above it, the whole payment goes back. £1. That is genuinely all the distance there is between keeping every penny and repaying every penny, because this is a cliff edge, and the rules make no apology for it. I find the design odd, to be honest, and I am plainly not alone, but odd is what got written down, so odd is what we plan around. Say your teacher's pension and your state pension between them leave you just short of the line, and a few good months of savings interest carry you across it. Say your late husband's works pension passes to you and lands on top of your own. Say you kept 2 mornings a week at the surgery because you like the people, and those mornings are the very pounds that tip you over. None of that is cheating, none of it is even unusual, and every bit of it counts. Honest, ordinary money is what pushes most people past this line, which is why I keep saying you should add yours up rather than guess. One more fear worth killing while we are here. Crossing the line leaves you owing nothing beyond the payment itself, with no interest on top. It is simply collected back through the tax you already pay, spread across the months. It is your decision whether that round trip is worth the bother, and that decision has a deadline. Now, Jean, 74, retired teacher, a terraced house she has owned outright since before her hair went grey. Her teacher's pension and her state pension together sit a whisker under the line, and she has never once thought about any of this. Then, in the spring, her nephew opened a garage, drowned in paperwork within a month, and asked the one person in the family who has never missed a deadline to do his invoices 2 mornings a week, for proper pay, because Jean does not work for free. She said yes before he finished the sentence. That small kindness carries her over the 35,000 mark this tax year. So Jean stands where 2 roads part, and the whole system is visible from where she stands. Down one road, she does nothing. £200 arrives in her account in early December, sits there through the cold months and helps with a January bill. Then the tax office, unhurried, takes it back through her tax code, a few pounds at a time, month by month. She loses nothing except the tidiness of her payslip, though you will shortly see there is a sting in the timing. Down the other road, she opts out before the September deadline. Nothing arrives, nothing is collected. Her code stays clean. But an opt-out is not a one-winter arrangement. It stands for the years ahead unless she steps back in. If the garage work dries up next year and her income drops below the line, the payment she could then keep outright would pass her by until she asked for it again. For a woman whose income hovers around the line itself, staying in is the road that forgives a change of fortune. Her neighbour Arthur is a different story, and he is the one I flagged at the start. Arthur's income is nowhere near the line. He heard one radio bulletin about the taxman clawing back winter payments, decided the whole thing had become a trap, and told Jean over the fence that he would be opting out to keep the revenue away from his affairs. For Arthur, the payment is unconditional. Opting out would have been a gift from his pocket to the Treasury, made out of fear and nothing else. Jean talked him down with the same words I will leave you with. Sit at the table, add up your income, and make the choice on purpose. Panic is not a plan. Time to close the loop I opened at the start. On the government's website, there is a guidance page called Paying Back the Winter Fuel Payment, and it repays slow reading. It confirms what those of you over the line may have already noticed, that last winter's payment is being collected through this year's tax code, about £17 a month for a typical £200 payment. Your current code may be carrying that deduction as we speak. Then comes the sentence I promised, and I am giving you its meaning word for word. Unless you opt out, the payments for 2 tax years, meaning this coming winter's money and next winter's too, will both be collected through a single year's tax code, the one that starts in April of 2027. The guidance does its own arithmetic. With a £200 payment in each of the 2 years, that code carries roughly £33 a month in extra deductions. 2 winters riding through 1 year's payslips. Only after that, from the tax year beginning in 2028, does the system settle into taking back each payment in the year it is paid. I will admit this part makes me cross. In the space of 3 years, the same payment has been universal, then means tested to the bone, then universal with a claw. 3 different sets of rules in 3 winters, and the people asked to keep track of it all are the ones these letters find hardest to read. Nobody at the top loses sleep over a doubled deduction in a tax code. The pensioner who never asked for any of this gets to notice it, or worse, not notice it, and fear the worst. You deserve the courtesy of being told in advance, so consider yourself told. Wherever money moves, the vultures circle, and this scheme hands them a gift. A genuine, well-publicised story about the taxman taking money back from pensioners. Expect texts and phone calls built on exactly that fear. So let us set down what the real thing looks like. The revenue has been contacting people it believes are over the line, and its real letters about tax code changes state plainly that no action is required from you. Its real texts and emails carry no links at all. They simply point you towards the government website to look things up yourself. That gives you a clean rule of thumb. A message about your winter fuel payment that contains a link, asks for bank details, or wants you to confirm who you are, is a fake every single time. The pensions department will not ring you to release a payment or to verify your account. Real money that you are owed arrives without anyone asking questions first. And if you do want to opt out, Do it yourself through the government website or the official phone line. Never through a number or a link that arrived in a message. A genuine deadline gives you weeks. A fraudster gives you until tea time. Here is the whole video folded into one sit-down with a pen, this week while the window is wide open. Add up your income for the current tax year, the one that ends next April. State pension, other pensions, any wages, savings interest, dividends, rent. Your own income only, your share only. If the total sits clearly under 35,000, your task is to do precisely nothing. Do not opt out whatever the radio or the fence line rumour mill says. The money is yours without condition, and come the autumn, your only job is to glance at the letter and check the amount looks right. If you are clearly over the line and you would rather keep the tax office out of the pantomime altogether, opt out properly. The online form closes at 1 minute to midnight on the 20th of September. The phone route closes earlier at 6 in the evening on the 18th on 0800 731 0160. Have your national insurance number in front of you, and remember the choice rolls forward into future winters until you reverse it. If you are hovering near the line, like Jean, lean towards staying in. There is no fine and no interest if the payment is later collected back, and staying in protects you in any year your income dips. And if money is genuinely tight, this is your cue to check pension credit, because it tops up a single person's weekly income to £238 and a couple's to £363.25, and it opens doors well beyond itself, from help with energy bills to a free television licence past 75. A claim can be backdated. 3 months. That is how far back they will pay you if you qualified all along. And the number to ring is 0800 99 1234. If forms are not your friend, Citizens Advice will sit with you through the whole thing. Age UK runs a free benefits check that takes minutes, and the government website carries every rule I have quoted today in black and white under winter fuel payment. Jean made her choice at the kitchen table with the garage's invoice book at her elbow. She is staying in. The £200 will winter in her account where it earns its keep against the January bill, and when the heavier deductions arrive in the April 2027 code, she will nod at her payslip like an old acquaintance, because she saw it coming, and so now do you. Arthur is staying in too, with his payment intact and his fear returned to sender. 64 days when I started talking, a little fewer now. Somewhere in your street there is an Arthur about to hand back money that is rightfully his, or a Jean who has no idea her small job moved her across a line she never knew existed. Pass this video to them. It may be worth £200 to the person you share it with. If you want the follow-up when the letters start landing in October, subscribe and ring the bell, and it will find you. And tell me below, are you keeping the payment or stepping out of the queue, and what settled it for you? I read every comment, and your answers write the next video. You worked for every penny of this. Make sure every penny knows the way home. I will see you in the next one.